Hello, everyone. Welcome back to the FinanceFy. Today, we're diving into a topic that's essential for anyone on their financial journey, the common investment mistakes that many people make and, more importantly, how to avoid them. These missteps can really impact your financial future if left unchecked, so we're here to help you understand and steer clear of these pitfalls to set yourself up for long-term success. Let's start with one of the biggest mistakes: emotional decision-making. Emotions play a huge role in how we handle money. Unfortunately, letting fear or greed dictate investment decisions can lead to some major regrets. For example, when the market takes a downturn, many people feel anxious and sell off their investments at a loss, hoping to avoid further declines. But this reaction can end up hurting more than helping. Markets naturally go through cycles of ups and downs, so selling when the market is low often results in locking in those losses instead of waiting for a rebound. The best way to counter emotional investing is to develop a disciplined strategy and stick to it. This involves creating a plan that aligns with your long-term goals and risk tolerance and following it no matter what the market does. Think of investing as a marathon rather than a sprint. Slow and steady progress is much more effective than trying to time the market or react to every dip and peak. Keeping a calm, long-term perspective during periods of volatility is one of the most valuable skills you can develop as an investor. Another common mistake is chasing hot trends. It's easy to get caught up in the excitement of a hot stock or the latest trend everyone seems to be talking about. For example, tech stocks, cryptocurrency, or any rapidly growing sector can seem tempting when they're making headlines. But jumping into these investments without proper research can lead to significant losses. Trends can shift just as quickly as they started, and high-risk investments may not always be suited to your personal financial goals or risk tolerance. Instead of following trends, focus on understanding the companies or sectors in which you want to invest. Take time to research each investment, looking into things like company financials, the industry outlook, and any relevant risks. By having a clear understanding of what you're investing in, you can make informed decisions that align with your objectives, rather than just jumping on a bandwagon. Now, let's talk about diversification, a crucial principle that helps protect your portfolio. Many investors overlook this and end up putting all their money into one stock or asset class. This can be incredibly risky because if that one investment doesn't perform well, your entire portfolio suffers. Diversification involves spreading your investments across different asset classes, such as stocks, bonds, real estate, and possibly other alternative investments. This strategy allows you to reduce your risk since these different assets tend to react differently to market conditions. For example, if the stock market dips, bonds and real estate may hold steady or even increase in value, balancing out your losses. A diversified portfolio is generally more stable, and less susceptible to the impact of a single underperforming asset, which makes it an essential part of a strong investment plan. Another often overlooked mistake is failing to keep accurate records. As you start to accumulate more investments, it's essential to track each one. Keeping good documentation of your trades, dividends, expenses, and performance helps you stay organized, but it also ensures you're prepared for tax season. Taxes can be tricky when it comes to investments, especially if you're dealing with capital gains, dividends, or other taxable events. Without proper records, it can be easy to make mistakes, which may lead to costly fines or missed deductions. One practical way to manage this is by using investment tracking software. Many platforms allow you to record your trades, set alerts, and generate reports, so you always know where you stand. By having all this information in one place, you can make better decisions, track your progress, and reduce the hassle when it's time to file your taxes. To wrap up, here are some key takeaways. Avoiding common investment mistakes requires a blend of discipline, research, diversification, and good record keeping. By following these principles, you can protect your portfolio from unnecessary risks and make more informed decisions that support your long-term financial goals. Remember, successful investing is about consistency and patience. It's a long-term commitment that, over time, can lead to significant financial growth.